Oh, same chart. You're saying it was 9:30 yesterday. Okay, we'll get to that. I do want you to just to keep in mind, don't get too crazed if the charts are different, because it opens up the door to say one broker's better than the other. No, my charts are right. No, your charts are right. Don't get too wrapped up into that. Just pay more attention to how you can make money with the charting package you have. There are some people that trade with one charting package and have actually never even looked very much at another charting package at all. So they don't even know if their charts are accurate or not. Do you follow what I'm saying there? So if they've always been with TradeStation, that's the only thing they've ever looked at. A dealing desk is not necessarily a good or bad thing. A dealing desk is another money making device for the broker. Okay. Um, and I'm answering Raul's question. Okay, it's basically another money making device for the broker, because the broker could go directly to the bank and not have a dealing desk and just have straight through processing. But it's another way. Many times the broker can peel, you know, something else off of the trade, for their in-house expenses. And many times, many of the brokers will take, uh, many dealing desks will take the opposite trades that you or a major player in their shop will take. Okay, and now part of the reason they do that is that they operate on the premise that most new traders are going to lose their money. So if they have statistical evidence to back that up, every time they see somebody new come into their shop, if that person goes long, they will take short, because they're going to operate on the premise that most of a new trader's trades are going to be bad ones. All right. Um, Phil is asking, do some brokers use a bucket service for profitable traders? Well, yeah. Phil is asking basically, do brokers have a separate server for traders who are profitable? What happens more often than not is many of the brokers may have a different feed or a different routing procedure for someone that comes in with a larger amount of money. All right, they will give them a little bit uh, different perk or a little bit different access to the market. That can really vary from shop to shop. So, for instance, if many of you call your brokers and look at your spread. Let's say your spread on the euro dollar is 2 pips. All right. The brokers will say, well, if you trade $3 or $4 million in volume during the month, and if you do that much volume during the month, we can lower your spread, because they'll make up the difference in the fact that you're taking a larger number of trades. So that's another way that a broker can tweak things a bit, depending on what kind of money you have in the account, what style of trading you're involved in. All right. The other thing they'll do is they'll say, if you come in with an account under $10,000, your spread on the euro will be 2 pips. If you come in with an account over $10,000, your spread on the euro might be 1.4 pips, because they give you, again, another reward for bringing more money in the house. They lower the spread for you. So many of these things are very specific to the broker. So you can't tag a broker and say that they have a bucket shop and they're doing this and that, or they're playing around, with your price feed deliberately to come and get you. All right. They have different perks, different feeds, different arrangements, different give backs that they can offer their clients based on their trading style and what size of an account they have. Did that kind of cover what you? Yeah, oh, Ken is asking, do market makers really exist? Yes, they do. Now, there are a couple of types of market makers, and I'll give you an example, and I won't mention the name, but this is a very, very famous educator for the for stock traders. Okay, uh, this person had a rather large and extensive school. They had many, many clients, and they had so many clients that for those of you that are familiar with stocks, you'll be impressed with this. He had so much volume and so many clients that he had a basket deal where any of the trades that came through his shop, it was a 2 cent round trip. Okay, so for you stock traders, if you can imagine having so much volume and buying power in the market, that your commissions were 2 cents round trip. Okay. Now, what would also happen was, according to him, he could place an order, let's say, for Facebook stock. He could place a pending order for Facebook. And because that pending order is out there, it creates a market. He's saying, I want to sell 500,000 shares of Facebook. And that market goes out, and the order sits there. And the order will say, I want to sell 500,000 shares of Facebook at price 50.50, $50.50, let's say. Okay? The fact that people can see that market order out there, it actually creates the market. So someone can look at a level 2 and say, okay, I see a lot of orders for Facebook at price 50.50. If I want to buy Facebook, that's the price I'd have to buy it at. So it creates, the marketplace. When you walk into a market, you need to have product on the shelf. Do you follow me, Ken? And because he would have these various market orders out there, he would actually get a kickback from the different institutions. He'd get a tiny kickback because he put those orders out there. Now, he doesn't have to fulfill the order. He would get his kickback just because he put the order out there, and now it created a marketplace. People can come and see what shares of Facebook are going for at that particular moment through him. So, and I won't mention his name. I don't want to get too much into detail. But that's essentially what happens with someone that could be considered a market maker. That's one example. There are many, but I'm giving you one that I know for a fact. This is how it was explained to me. Okay. In fact, he had so much buying power. He would brag and say, "You give me the name of a stock, and I'll go to my computer right now and buy my method of buying and selling. I can create any candlestick you want to see." So if you wanted to see a bearish engulfing, he would buy and sell in such a way that it would create a bearish engulfing candle. If you wanted to see a doji, he could do that. At least this is what he claimed. Okay, he claimed he had that much buying power. The other thing that this particular educator did was he had computer programs. When you signed up for his course, you would be tied into his computer system via the internet, and they would teach you how to use the hotkeys on your keyboard to buy and sell. And because your computer was tied into his system on the internet, he also had a computer system on his side that would instantly take the opposite trade that you placed. Again, under the premise that you were going to be wrong. So if you bought, 500 shares of Caterpillar, he would instantly sell 500 shares of Caterpillar, because the odds are, at least in his thinking, the odds are you were going to be wrong. And if you were right, well, it didn't hurt him that much because he had plenty of other students every place else that were wrong. Okay? So this is how some of these things exist behind the scenes. And I may have gotten a small detail, twisted here and there, but that in general those in general are some of the types of things that occur. All right. Now, as Jem is saying, that would be cool. Yeah, would be cool if you could create any candle you want. But again, this is what he said he could do, and he apparently had the buying power to do it. Okay, Kem is asking Lou, show me a doji on this current candlestick on Euro Pound. There is no doji here, Jem. Oh, I wish I could. Oh, okay, that's funny. Okay, so let's look at these two price traps that were on this chart here. Could we please look at Euro Pound 15-minute yesterday? Okay, we'll do that. And I just want to show you these two price traps that were here. One came after a dramatic drop. Okay, this was obviously some sort of European news. Okay, and we had a price trap here. And again, location. I will go back to yesterday's 15-minute pound yen. Wait a minute, is that Euro Pound you said? Where is the entry on the traps? Matt, were you here for any of this week's lessons? Because we covered the entries in numerous times, and I will cover them again. I just need to know where you are so I know what to explain. We covered many types of entries. Okay. Again, the concept of the trap is you have your primary candle with two candles that follow it, and neither of the candles can close above the high or low of the trapping candle. Do you see that? Now, this larger black candle could have also been considered a price trap. However, what often happens is inside this larger candle, you end up with a smaller trap developing also. I like to move down to the smaller trap because I can decrease my risk. And the number one rule is in trading is similar to the number one rule in boxing. Are there any boxers in here? And can anyone tell me what the number one rule in boxing is? The first thing they say to you when you walk in the gym? Just curious. Well, no, not don't fall down, but that is kind of good advice also, Jem. At some point, you need to explain location. I explained that very, very carefully. Oh, no, I didn't explain it carefully. No. I gave you a couple of examples yesterday, Bull Hamster. Location is where a certain thing happens. Okay, Brian is saying duck. Jay is saying big candle. Okay, Mike's got the answer right there. The first thing they always tell you when you walk into a boxing gym is to protect yourself at all times. All right, that's the first thing they tell you. Protect yourself at all times. In Forex trading or any kind of trading, the number one rule is protect your capital at all times. Okay? Protect your capital at all times. So that's why if I see a smaller price trap develop inside a larger price trap, I go with the smaller price trap because my stop will be smaller. Okay? On this first price trap, price trap broke long. I'm just going to draw the width of the trap. All right? And again, 1 times the width of the trap is a good place to take some profit off. And then the ultimate target would have been 2 times the trap, which we didn't get in this case, but we certainly made 1 times the price of the trap. Okay? And I'm always looking to pull some profit off when possible. All right? And now let's look at the second price trap. And you guys seem to like price traps. It's funny, different groups like different things. This is the price trap group. Here was our price trap here. And again, our goal is twice the price trap. I'm going to go a little bit below this box for the entry. And this second price trap would have produced twice the width of the box in profit. Okay? Uh, Now, I just want to be clear. Is everyone clear on the definition of a price trap before we go on? Okay, Brian is saying defining your bias is the hard part to get right. Um, okay, I'm trying to read the questions here and understand what's going on. Brian, I understand defining the bias. We'll get into defining the bias in a minute. I talked about that yesterday a bit. Ken is saying, can I be in the 200 pip run group? You certainly could, Ken. All right. Now, Mike is saying, definition, yes, but there seems to be so many and often conflicting direction signals. Oh, okay, Ken, I understand. You were saying that, yeah, different groups. Yep, Mike, there are plenty of price traps, but the idea is to look at the whole chart and try to pick the best looking situation. And I'll get to that. I'm just reading the rest of these texts. A set of two price points in the market cannot close above or below the high. Okay, you kind of got it, Gene. But remember, Gene, it's a 3-candle setup. We need 3 candles in order to make a valid trap. Okay, you got that? We need 3 candles to make a valid trap. All right, it's always a 3-candle. And the reason I mention this is when we get into chart patterns, some chart patterns are always 5-candle patterns. Other chart patterns are always 8-candle patterns. Or some chart patterns, you need a minimum of X number of candles for it to be valid. So I want you to think in those terms. All right. With the price trap, there's no flexibility in it. It's got to be 3. Now, after the 3, it could go 25 candles sideways, but it has to be 3. No, Matt, I am in the process of putting together some PDFs, but I need some time to do it. And I also want to mention one other thing. This coming Sunday, Monday, and Tuesday, there is a trading expo in New York City where all the major brokerages will have booths set up. It's like a convention, and I will be attending that. And so there is a possibility I may not be here Tuesday, depending on what is going on at the convention. All right. So just keep that in mind for Tuesday. And I do want to tell you, next week we will start on support and resistance. All right, that'll be the focus of next week. Phil is saying, aren't there often signals long and short at the same time, and some traders buying while others sell? So the secret is in the trade management more than the entries. Hence, why coin tossing can work. Okay, and I'll get to that in a minute, Phil. Michael is saying, no, Brian, because 4th candle may still be between the high and low of the master. Okay, so Brian must have asked a question that I missed when I was going over something. Brian, the price trap is a 3-candle setup. Once you have the 3, you have a valid trap. Now, the trap can go 20 candles wide, but it's not valid until you get the first 3 candles to set up properly. Now, Phil is saying, aren't there often signals long and short at the same time? There are always signals long and short, no matter what chart you're looking at. You got me? Right now on this chart, we could go long or we could go short. What our goal is to try to interpret where the market wants to go. And remember, the market never moves in the wrong direction. The market always moves in the correct direction. Our job is to try to determine from the charts which direction that might be. Okay? And then our next task would be, how can we take advantage of that? Does that make sense, Brian? And to go to Phil's question about, aren't there often signals long and short at the same time? Nobody knows where the next tick is going to go. I'll get to that question, Gene, in a minute. Um, Phil, no one knows where the next tick is going to go. So you could take a long or short at any point on any chart. All right. Again, our method is to determine where are we in price action and historically what happens during that particular building block of price action. All right. And we try to get chart-based evidence. We try to look at the chart and determine which way we believe the market is going to go based on what we see on the chart. Does that make sense, Phil? We can't predict. All right. When you look at some of the major, some of the big firms, and you look at what a lot of their fund managers do, many of them have success rates no greater than 40-45%. All right, so they're not picking the tops and bottoms either. They are certainly not, hitting 80% wins. But what they're doing, and again, I sat with one, and the one that I sat with scared the daylights out of me when I looked at how they were basing their decisions, and I could see why they were 40%, successful. What tips the advantage in their favor? No, Phil, 80% is not for scalpers, but I'll touch on that for a minute. What tips the advantage in the favor of the larger shops is they have outstanding money management, most of them. Okay? Most of them have very, very good money management. Okay? The idea is to walk away profitable and not get too wrapped up in I have to be 75 or 80% accurate. The idea is to walk away profitable and understand that you will give a couple of trades back. That's part of the game. Okay? I personally prefer to use a model similar to what many of the larger funds use, where I go for very large rewards with minimal risk. All right? Because these guys, they don't make mistakes for the most part. They always make money in the end. Now, we may not, as retail traders, and we may not have the stomach for their drawdown curve, because they may have 6, 7, 8, 10 trades in a row that don't pan out. But then they'll hit 2 or 3 that will, and they'll get back everything they earned. Where with the average retail trader, they will have 8 or 9 trades work out profitably, but because of poor money management, they could end up with 2 or 3 trades that could take all of that away because their risk reward is upside down. All right? Yeah, well, Gene, what the casinos do is that they have ways of stacking the odds just the tiniest bit in their favor. If you look at a roulette wheel, there's 36 numbers on a roulette wheel, Gene, am I correct? I just want to get Gene's okay. But how many slots are actually on the roulette wheel? How many places can that ball fall on the roulette wheel? There are 36 numbers on it, but how many slots? Okay, now what they do, yeah, exactly, Rob. There's 0 and 00. When they put that 0 and 00 in, it ticks everything in their favor. Just that one addition puts the odds just the tiniest bit in their favor, and this is what they work on. A tiny edge that they do over and over and over again. Okay? And yeah, Bull Hamster, they do have high volume. They get a lot of people showing up at those tables. Okay? Now, the fact that the win rate is slightly over 50% isn't the issue. What happens is that the casino loses very little, okay? But they get a whole lot from you. and that goes into the risk reward ratio. All right. And okay, Curry is saying that my ratio is also better. Well, I that was one of my targets, was to try to get a good risk reward ratio. Okay, now Jose is saying, could you elaborate a bit on risk reward for me and what you consider a good ratio? Okay, I'll touch on that for Jose. What the term risk reward talks about is how many pips are you willing to risk in order to hit your profit target. Okay, so I'll take some simple numbers here. Let's say you're willing to risk 10 pips. Okay, but your goal is also 10 pips. Well, this risk reward ratio is basically 1 to 1. All right, so if you risk 10, you'll make 10. If you lose the trade, you lose 10 pips. Now, what this means is, in order to get your 10 pips back, you first have to win one more trade to get you back to break even. So now you're back to break even. All right, you're back to your original 10, and then you need one more trade to actually win to get the 10 pip win you were looking at before. So when you lose the 10, you actually have to get 2 winning trades to get you back into a winning position. Does that make sense, Jose? Okay, great. Now, the other thing that happens in Forex, as someone just mentioned, I was going to touch on, is that you also have a spread that you're paying. All right, so if you're risking 10 to make 10, you're actually risking 10, but the market has to move the spread. So if the spread is a 3-pip spread, the market has to move 10 pips plus the 3. You got me? So the market actually has to move 13 pips. So you will need 2 trades to get you back to break even, and then possibly a third trade to cover the, what you're going to use on spreads on all 3 of these. So in order to get yourself back to a true zero, you would need a bit more than 2 trades to get you even again. And I'm going to post some charts on this. There has been a lot of study on money management and some of the various ratios involved. And I believe I'm going to be using Dropbox. So if you guys don't have Dropbox, look into downloading it. It's free, and most of the files that I'll be sharing are well within their limit. Okay, because I have a ton of written material from different authors that I think would be very, very helpful to everyone here. But it's sharing it in a easy fashion is what I'm trying to work on. The file sharing capacity in this room is a little bit buggy. Okay. Box, B-O-X, Gene, it's Dropbox, yes. All right, so now, Jose, going back to this, what you ideally would like to have would be a situation where you risk 10, but you want to have your take profit, let's say at 20. Oh, wrong box. You want to have your take profit is at 20. All right. So what that does is, if you lose, if this trade doesn't work out, you've lost 10. But when you take the next trade alone can get you right back to break even. You don't need 2 trades. You follow me? Because what you were looking for was twice what you were risking. Do you follow that, Jose? Okay. If you're risking 10, a better risk-reward ratio would be to go for at least 20 pips. Because if you lose this 10 pips, how many trades do you need to get back to the 20? All right, you only need 1 trade. Because remember, you're going for 20 pips on each trade, not 10. So if you lose this 10, okay, you're down 10. If you take the next trade and it's successful, you're now back to 20. You got that? All right. Now here's a good example. Now Raul is saying that's the ratio you like, Lou, better, or you recommend that better. I personally like to look for trades at 3-to-1 or higher. And if you notice, all the trades that we've taken in this room live have all been 3-to-1 or higher. I don't know if I have the sheet in front of me. Oh, no, we had one trade that was 2-to-1. All right. I personally like 3-to-1 because that gives me two shots at it, and I can still get back all of my money, and then on the third trade I'm in profit. All right. I personally like 3-to-1. I find these trades well, we did 5 of them already, Curry. How often do you find that? They're all over the place. All right. Yes, Raul. Stop loss at 10 and take 30. You're correct, Raul. And that's why I look for certain types of setups. I like that larger risk reward. Now, it also means I will take less trades, because to look for those trades, you're either going to pay for it in risk by being risky and taking a trade that's kind of iffy. You're going to pay for it in risk, or you will pay for it in time, meaning you may have to wait an extra hour for the whole candle formation to form. So that's going to be a personal choice, okay? Today we're doing review J101. I'm not sure if I mentioned it earlier, but on Fridays I try to review anything that went on during the week. So if there's a chart pattern, if there's some other information you want to go over, and for the new guys, I try to go over some of the basics. Today I just want to touch on order types a little bit later, so you understand the different types of orders, because they'll come in handy when we get into other types of trading. Okay? Yeah, Jay, I realize you're one of the new guys. All right, so we always want to look for risk rewards. Me personally, at 3-to-1. Okay, I want to risk $1, but I want to get 3 back. Okay. The only time I go below a 2-to-1 risk reward ratio is when I'm hyper scalping. And then the only reason that I do is because of the spread. Because when you hyper scalp, like you're pinpointing exact spots that you want to enter, and if you're looking for a 3 to 5 pip profit, no matter what pair you're on, if you've got a 2 pip spread, you almost by default have to move your stop loss out to 5 pips. You know what I'm saying? All right, now Curry's asking me how many trades on average a day do I take? I take what the market gives me. Okay, I don't look to take a number of trades. I look to trade the best looking chart. Some days I get 3 or 4 trades. Other days I only get 1, or I only choose to take 1. And some days I may get 8 trades. But I'm always going to be trading the best looking chart. It's not about how many trades. It's about trading the best looking chart. Okay? And I give myself a daily allowance. Okay, my daily allowance for me is, no matter what the time frame is, I am never going to use a stop more than 20 pips unless it's a real slam dunk chart setup. And this is what I'm trying to show you guys. I mean, the first trade we took had a 10 pip stop and a 75 pip take profit. That was 7-to-1. I could have had 5 stop outs on that trade and still went in the 6th time and walked away profitable. All right, we did an example the other day about risk reward, and somebody just posted a risking 10 to go for 30. I just want to see who that was. Raul. Okay, so what happens with the 3-to-1 risk reward ratio, Raul? Uh, let's assume, do you take mini trades that run 100 pips or more? Yes, I do, Ken. My intraday is how I make like pocket money, and my long-term trades are the ones that I kind of call my retirement account. And I've got I've got, don't even get me started on it. I've got 4 different accounts, and they're all designed a little bit differently to do different things. Okay? But the trades are not hard to find, but you have to be patient. You know, you have to have your setup and you have to have your rules. And this is what works for me. I'm not saying that it's going to work for you. But I am saying if you want those longer term trades on a consistent basis where you've got a high shot at winning, then you want to really look at certain types of rule-based trading and waiting only for your setups. Okay? So let's assume that you're risking 10 to go for 30, Raul. Ravinko, if your risk reward is 3-to-1 and your max stop is 20 pips, what is the amount size you use? That depends on which account I'm trading. Okay, I try not to trade any more than about 3% of an account total. Some accounts I have just a modest amount of money in because they're designed to pay little bills in the house, let's say. Other accounts I have a bit more money in, so that 2% comes out to a larger amount of money. Okay? Yes, well, 500, oh yeah, plenty of them. Raul just asked a question. Is there guys out there that have their PIP worth $500 or more? Yes. I know a great number of them. Okay? Where they will take a trade and they'll pop 10 standard lots. Okay? So at 10 standard lots, you're looking at $100 a pip. All right? And there are other guys that trade huge contracts, and they'll go up to $500 or $1,000 a pip. A standard lot, Ravinko, is $10 a pip, and depending on what country you're in and what amount of leverage that is, that determines how much of your equity is held to the side. And I'll explain that to you in a minute. Okay, now Curry is saying if the risk is greater than 20 pips, couldn't you divide the bigger pip stops with your fixed equity percent or risk per trade? I don't quite get what you're asking me, Curry, but I'll give you an example. Let's say I'm looking at a short trade. Okay, let's take this chart right now. Let's say I'm deciding to go short below this box right here, and this box has nothing to do with it. Let me just take this off. Okay, let me just get rid of this box. Let's assume I'm going to go short below these pin bars down here. All right, and my target, and I'll explain the math in a minute. My target is this low, so from here to here, it's about 10 pips. Okay, nothing big, but if I were a scalper, I'm trying to read these as you're going along. Oh, you know what? I'll do this a better way. Let's assume you have a $5,000 account, Curry. All right? And in that $5,000 account, you don't want to risk any more than 3% of your capital. So in that $5,000 account, 3% comes out to $150. You with me? No, Raul, 25% of your capital is really high-speed gambling. Okay? In fact, I'll show you a spreadsheet in a minute that may help solve some of that. Manuel, we'll go back to that flag pattern in a second. I just want to walk this through for Curry's sake. Let's assume that you have a $5,000 account, Curry, and you're not going to risk more than 3% of that account. So if you do the math, 3% of 5,000 comes out to $150. $150 is 15 pips on a standard account. Do you agree with that? That's 15 pips on a standard account. Okay. If I see a trade that's going to take the 15 pips, that could probably be the only trade of the day for me. All right. However, if I look at that trade, I could choose to trade it as a mini account, meaning $1 per pip. Now that same $150 or that same 15 pips in a standard account now has turned into 150 pips worth of stop that I can use. So I can take the same trade as a mini account and only use half of that 150 and give myself a 75 pip stop. And I know that might be going a bit quick for some people, but do you understand that, Curry? Raul, any of the new guys, do you understand that? On a standard account, 15 pips is $10 a pip, but that same amount of money on a mini account is 150. All right, so Curry's saying, so if you, so, oh boy. I'm trying to understand what you're trying to say here, Curry. So if the stop is bigger, then just divide that with the greater pip from your 150. Well, no, what I mean is if that $150 is your allowance for the day, how you break that up is up to you. Okay, I would choose to use it and have 150 pips worth of stop. This way I could take five trades with 50 pip stops each. I'm sorry, 3 trades with a 50 pip stop instead of 1 trade with a 15 pip stop. I can take 10 trades with 15 pip stops as a mini account. You see, I get more flexibility by dropping down. All right? I get far more flexibility by dropping down to a lower denomination or lower leverage. And just let me show you something. This was for a lesson down the road a bit, but I'm going to show it now since this whole thing came up about money management. This is a spreadsheet. Now, a couple of you guys that know me have seen this already, but this is primarily for the new guys to take a peek at. Let me know when you see my screen and you see the spreadsheet on the screen. I just want to get it as full size as possible. Oh no, I have to go in a couple of notches. All right. Okay, now this is for Raul, J101, Gene, and any of the new guys in particular, but it's actually all, for everybody. This is something I designed with a friend of mine to help me with money management and as a teaching tool. All right, let me just change this. Okay. And this is something to help you understand what trading is about and what how you should get your head wrapped around making money in this market. Because what you read in the books and what you see on the forums and some of the other stuff that they tell you about how many pips you should or shouldn't be making, a lot of it is interesting, but not the reality for most traders. Okay? So what this spreadsheet does is it allows you to calculate how much you can trade in your account, and it gives you a few different parameters to work with. And I'll share this with the room when we get to these lessons on money management. But since this came up, in this column, this is my starting daily balance. Okay, now here it says 50,000. I was teaching this with someone a few days ago. But let's start with a $2,000 account. Okay, so we're going to start with $2,000, and let's assume that we're going to risk 3% of that $2,000. All right, so in a $2,000 account, 3% of $2,000 is going to be $60. So we're using $60 out of this 2,000. Okay. Now Gene is saying 600. 60. Oh yeah, Gene is a math major. Okay. Okay, that's good. I'm glad that you can catch me if I make a mistake, Gene, because I'm not the sharpest pencil in the cup when it comes to certain things, and I'm humble enough to admit when I don't know something because I enjoy the learning of it. Okay, so 3% of and Gene, I want you to help me with this math too, because this throws a lot of people. They don't quite understand this. 3% of $2,000 is $60. You with me? So I'm going to risk $60. That's my budget. $60. Now I can divide that up any kind of way I want. In this spreadsheet, if I'm doing a standard account, and here you see a tick dollar value, I did this for stocks and for Forex. So I just called this tick, but tick also means pip. So if I'm going to trade 3% of this account, I'm going to trade 0.06 lots. Okay, 0.06. And my daily target, and here you see tick's profit, my daily target will be 20 pips a day. Everyone follow that so far? I'm risking $2,000. I have $2,000 in my account. I only want to risk 3% of that. And again, this is going to be how I explain it. 3% is my budget for the day. Now I can split that up any number of ways, and I'll show you another spreadsheet, that takes that into account. And I'm using $60 as my margin, and I'm shooting for 20 pips a day. So if I take a trade at 0.06 and I make my 20 pips, my net profit is $12. Now some of you will say, whoop-de-damn, that's nothing. Okay? But if you understand that effective trading is a marathon, it is not a sprint. Okay? Now, let's operate on the assumption that you get your 20 pips every day. All right? And you have no losing trades. I know that's not reality, but we'll tackle that in a minute. Okay? What I want you to see back in the first column is as the account rises in value, you'll see that once we make enough money, we now are at $2,100, and now we're trading 0.07. But do the math. The 0.07, we're trading a larger lot size, but that still comes out to only 3% of the account. We never risk more than that 3%. Okay, that's one of those rules. That's one of my rules. Like you've got the 3 candles for a price trap. Never risk more than the 3%. How you divvy that up is your business. You got me? All right. On a micro account, this could be 60 pips worth of stop to $65. On a mini account, it will be 6 pips. Do you understand that? You divvy it up the way you want, but you never risk more than that 3%. As the account continues to grow, let's go down to where we cracked $3,000. It's down away. I'll wait for it to stop. I know there may be a delay. Now we're at $3,000. We're only risking the same 3%, but now we're trading at 0.09. You got that? We never risk more than the 3%. Now, this in part is why I have different accounts for different things. Okay, one of my accounts does little bits of money like this, but it does it over and over and over and over and over. So it turns into something later on. Okay? Now, if we never have a loss, and I know that's not reality, and we'll deal with that in a minute. If we never have a loss, at the end of the year, the top portion here, balance at year end, we have turned $2,000 into $9,000. Okay, we basically quadrupled our money in 1 year, only trading, not even trading a half a standard lot. Now, this is based on a margin of 100 to 1 leverage, because a lot of the people that I work with are outside the United States. So this is based on 100 to 1 leverage. So in the margin per contract is $1,000. And I'll explain that to you in a minute. Okay, any questions on this part? Yeah, Gene, I'll get you a copy when we get to that point in the lesson. I find that people get super distracted with this. I thought that the 3% risk is generally meant for each trade. Absolutely not, Ravinko. Boy, that's an outstanding question. That is really, really outstanding. And it shows that you're thinking. Here's where most traders get themselves, they get their asses in a vice. 3% is now, this is how I do it. All right. And again, I have to preface that. You will read something or see a webinar or see a YouTube where they may say something different. I am saying, and I tend to be very conservative and I tend to try to protect my capital. I am saying that 3% is for the entire day. Okay. So if I take this whole 3% and if I do a 0.6 trade, okay, that I'm using all of it on that one trade. If that one trade does not work out, then I'm done for the day. Do you understand? This is my risk for the entire day. All right. What happens with most people, how they get themselves in trouble, it'll say never risk more than 3% on a trade. So that means if you see trade A, you'll risk 3%. And then here's another trade. Wow. Then you thinking you're doing the right thing, you risk another 3%. What you've actually done is now you're risking 6% of your account. And if you see 4 trades, all of a sudden 10% of your account is at risk. 12% of your account is at risk on 4 trades. But you think you're doing the right thing because you're doing 3% per trade like they said in that book or on that video or whatever. And that is the fast track to disaster until you get comfortable working with the charts. Do you understand that, Ravinko? Okay. The only part of the trade that you have total control over is the entry and your risk. And of the entry and risk, the most important of those two is your risk. Yes, and it does depend on how profitable the strategy is. All right. Now you can divvy up this $60 any way you want to. All right. But if we have no losing trades, you will quadruple your money. Hedge funds will beat your door down to come and get you if you can do this on a regular basis. All right. And you're risking nothing in essence. You know what I'm saying? Because if you lose this trade, now here's the interesting part about this. If you lose this trade, you lose $12. Do you understand that? Now, Gene, the math expert, $12 is what percent of 2,000? Gene? Not quite. Not quite. Yeah, $12 is what percent of, oh, I understand, not quite an expert. Okay. But you did say you were a math major, I believe. But $12 is what percent of 2,000? Okay, Rob Rice has got it, 0.6. Okay, Gene has 0.06. Okay, correct. Which is correct, Gene? I believe Rob is correct. Okay, it is 0.6. Okay, so now listen carefully, and this is where guys get confused. All right, we're risking 3% of the account. You understand that? However, if we lose the trade, we are losing less than 1% of our capital. Understand that. You lose, you know, if the trade doesn't work out, you've lost less than 1% of your capital. So that's why this 3% number ends up being quite valuable. If you're willing to risk more than that much on your capital, then you can trade a higher risk amount. And I'm going to do this, and then I'll need a little help with the math. Let's say you wanted to risk 7% of your account. Okay, 7%. We're now trading 0.14 lots. All right, we're risking 7% of 2,000, and that comes out to 140 bucks. However, we're looking for 20 pips a trade. If we make the 20 pips, okay, yep, it's at 140. It's right there, Gene. If we earn the 20 pips, we make 28 bucks. If we lose the 20 pips, we lose 28 bucks. So now $28 is what percent of 2,000? Because remember, 2,000 is your inventory. In your Forex store, your inventory is your account balance. All right. Okay, very good, Phil. Do you guys understand that? That now we're risking 7%, which is like 3 times what the experts would tell you to risk. But I want you to understand the difference between percent risk and percent of capital. Sometimes they skip over this and they don't explain it properly, so you don't understand what's going on in your account. So if we lose, if we have a trade that doesn't work out and the trade loses 28 bucks, again, we've only lost 1.4% of our capital. We're still well under the 3% of your capital risk. Does everyone understand that? The difference between percent risk of capital and equity risk of capital? The equity is your cash. Okay? And if we did this, risk 7%, we would turn 2,000 into 74,000. Okay? Now, I've run this chart a number of times, and I've made some decent money with it. Okay? I have rarely gone past the about the $11,000 mark. Okay? Only because I knew what my targets were, and I was trying to do bills. I took both my daughters on cruises for their 16th birthday and all that kind of stuff off of the same spreadsheet. Okay? So I want you to understand, don't get so panicked that, you know, if you hear people talking about how many pips they're making and you're only making 20 to 30 a day, incoming mail. Don't let that bother you. Remember, this is a marathon. You're in this for the long haul, because once you get this right, you've got it for life. For the rest of your life, you can make money off of a chart. And ideally, you can make money off of a chart with candlesticks in a straight line if you have nothing else. You know, when we get to indicators and I explain the proper place indicators should be used and which indicators best match up with chart patterns, you'll see the power in indicators. I'm not saying indicators are bad at all. I'm just saying that most of the time people learn the business upside down. All right? So you got that now. So we risk 7%. We lose if the trade doesn't work out, it's 28 bucks. 28 bucks is only 1% of your money. You're still very, very, very safe. You understand that? I'm not going to teach you anything reckless. You can be reckless if you choose to. And I got to be honest, I've done it in the past. Sometimes it worked out spectacularly. Other times I was just ready to kick the dog in the whole 9 yards. Okay? So, you know, I've got a little bit of experience on the very, very good and the very, very bad of it. Okay, so that's what this spreadsheet is kind of designed for. Now, let's take the scenario where we don't live in a perfect world. All right, so let me slide this over. Now, I'm going to go here to this column where it says percent losers. All right, let's assume X percent of our trades don't work out. Someone give me a number that they think would be realistic. X percent of your trades don't work out. What percentage would you guys want to put in here? Okay, Phil is saying 50. Brian is saying 50. Okay, let's say half the trades are losers. And Now, let's say the amount of loss, we're going to pick a range. Now, because we're using 20 pips as our profit target, I'm not going to go past 1-to-1. You got me? So we're going to go 20 is going to be the maximum loss. And what do you want to pick for the minimum loss? You guys understand that? The losing trades are going to be in a range between X and 20. So we have 20 because our take profit is 20. Do you guys follow me? So what would be the low number? No, it doesn't allow for spread. Spread isn't that much of a worry. And because spreads fluctuate so much, you can't properly calculate it into this. Okay, so Jose is saying 10. So does everybody understand what's going on here? Is that half our trades are going to be losers, and the losers are going to be in a range of between 10 and 20 pips. Does everybody see that? Yes or no? Everybody understand what we're looking at here? If there's a question as to what these numbers represent, let me know. Okay, cool. So now we've got that, and now I come back to the spreadsheet, and all of that is calculated in. Now, if we lose 50% of our trades, we still end up at the end of the year profitable. You see that? It's only $700 profit, but it's profitable. All right, and that's with losing half of our trades. Now, I want to show you a couple of things how this calculates that also. As I roll down, as you see, when we have a winning trade, we had $28 that we made here. That $28 comes over to the first column. So now we've gone from 2,000 to 2,028. Everybody on board with that? I'm not sure if there's a delay or a lag. You see the 28 profit we got here, we put it in here. Okay? And now we still risk 7%. And with that keeps going on and on and on. I want to go to a place where we had a loss where there's a difference so you could see it. Okay, right here. On this particular trade, we lost $17. You see that? Now you see here we have 2,128. But if you look at the next line, line number 10, it's only 2,110. The spreadsheet took out that loss and calculated it right down there. And now we're trading 7% of that, which still comes out to 0.15. I could have stretched this out to a whole bunch of other digits, but it didn't make sense because you can't split the you can't trade 0.155 lots in your broker. You get me? So I kept it to what the broker will allow you. All right, let's roll down some more. Okay, here's another example I want to show you. Here we had a 15 pip loss, and it was at $23 in cash. All right. Here we had 2,223. And now look, at trade number 22, it was 2,200. So the spreadsheet took out the $23 from here. But what it also did, on this trade, we were trading 0.16. But now our account has fallen to a point where we have to go back to 0.15. So the spreadsheet always keeps you in line with never risking more than this 7%. All right? So Curry is saying your calculator shows 1% or lower equity per risk per trade. No. You're seeing this all wrong, Curry. It's not showing 1%. It's showing the relationship between the numbers you put in. You got me? Whatever numbers you put in, that's what it's going to represent. All right? So everyone see that. So in this spreadsheet, you can put in the percent of losers, a range of how much you lost, how much each loss would be, and you can still see the results at the end of the year. All right? Everybody good on that? Any questions in general? All right. So don't get so wrapped up that you got to make 1,000 pips an hour to make money. If you're willing and if it's in your mind that you want this as a lifetime income, then be prepared to look at this as a marathon. Yeah, I have this set up for a couple of different accounts, Gene, but that's my own personal thing, and I won't get into all of that at the moment. Oops, I hit a button here by accident.